Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 223 for May 7th, 2019. If you've not had a chance to look at today's report yet, we will be discussing report number 293, which you should be seeing on your screen right now while I'm talking. And you can also get your copy if you want, if you go to TimingResearch.com/reports. And you can get access to either the PDF or web version there. We are broadcasting live on YouTube at 1 p.m. Eastern Time, but you can also listen to the audio-only podcast version of all episodes on iTunes, Spotify, Stitcher, Podbean, or wherever else you listen to podcasts. Just search for Timing Research and subscribe. My name is David Kosmeter. I'm the creator of Timing Research, and today I have arranged for my friend Michael Guest to join us for the first time. So welcome to Michael.
Thank you very much.
Also, Mark Sachs and Jim Kenney are with us again, and Simon Klein is back to moderate today. So I'm going to go ahead and turn it over to Simon.
Thanks, Michael. It's great to be back here again, and it's great to moderate for the second time. So what I'm going to do is let's go through each of us, and I'm going to go through the order I have here and ask everyone to introduce themselves and talk a bit about their site or a little bit about themselves and what they're doing. So let's start with Michael Guess of Day Trade Safe.
Well, thanks for that intro. I appreciate it. My name is Michael Guess. I've been a professional day trader for, close to 25 years. And I have been teaching and coaching people on how to day trade for going on 20 years now, and you can see my site at daytradesafe.com. It's all one word, daytradesafe. I have created indicators, mechanical trading systems, etc. for a number of years, and primarily I do offer a mechanical trading system, no guesswork involved whatsoever. It's a strict mechanical automated trading system, and it is accompanied by a full course and coaching. If you want to know more about it, get in touch with me. All right, who's next?
Thanks, Michael. It's great to have you here for the first time. And let's go over to Mark Sachs of RightLineTrading.com.
Hey, excuse me. This is Mark Sachs from Right Line Trading, and we're located at www.rightlinetrading.com. I've been in the markets. I've been trading the markets for close to 15 years, and really our software, our trading methodology, our mentorship programs are based on an analysis of the market that I think is a little bit unique. I mean, we look at each market as a closed system, and then we look at what forces come to bear on that closed system to move price. And it's sort of an analytical model that is based on the optimization of any multivariate equation. And our software has a lot of predictive value in determining the future direction of price. We just started with a newsletter looking at FDA approvals on small biotech companies, but primarily we look at futures, forex, and stocks. And so if you're interested, just head over to my website and our phone number's there.
Okay, thank you, Mark. Let's go over to Jim Kenney of OptionProfessor.com.
Yeah, thanks. I'm the content provider over at OptionProfessor.com and have been for decades. What we do is we've had seminars, both live and also online for many, many years, educating thousands and thousands of people on the uses and the risks of options. And every Friday, we have a market update podcast that we offer that at the end of the broadcast, we'll explain how you can get, where we cover our views and our opinions on stocks, bonds, gold, oil, and the dollar, and give you an idea of where we think the directions are. And that's it.
Okay, thank you very much, Jim. And over to me. I'm just looking to see how to share my screen here. Here we go. So you should be able to see my screen now, I think. Maybe not the right screen. Okay, well, we're showing the wrong screen. Let's try again. Should be this one. So I think we're showing the wrong screen here. 1 second, let's try again. Maybe it will work on this one. Nope. Let's try again. You should be able to see. Okay, got it. So there's a little bit about me. I started TradeSmart a number of years ago, and the website is tradesmartforex.com, and we've been training traders from beginner to advanced to professional trader for many years. And our approach is a two-pronged approach. We first start by teaching traders how to read the market professionally, and with no indicators. We're price action kind of traders. And once you know how to do that, you can derive your own trading system and trading plan and trading strategy. But that's not enough. What we do after that is go on to teach our traders how to run a successful trading business, including how to build their own trading plan, which is tailor-made to fit their personality and lifestyle. I'm a firm believer that it's very difficult. It's not a one-size-fits-all. It's not just because someone else can do it and they're successful doesn't mean that you'll be able to do exactly what they do. So you have to really tailor-make it for yourself. But you also need a framework and a process in which you can develop yourself safely as a trader when you begin, so that you make sure when you get through the learning curve, your capital's still intact and you can then go on. Because if you run out of capital before that process completes, before you get to the end, to the success, then you've got no money to trade with. So it's very important to preserve capital, and this is what this program will teach you. Okay, so let's move on to the first question in the report. Switch this off again. So the first question, and we'll go through the same order, is which direction do you think the S&P 500 index will move from this coming Monday's open to Friday's close, as in from May the 6th to the 10th? And what I'd like you to do is rate your confidence in your answer by giving a percentage of, that you've correctly predicted next week or this week's market move. So let's start with Michael Guess.
Well, thank you. Again, I'm the newbie here. And first, I want to emphasize that TradeSafe is not about position trading. And the wild card, especially in the last year where there was super high volatility, has been political. Whatever happens in Washington. So strictly looking at the charts, as I'm used to doing from a technical point of view, only can go so far, because you never know if a random tweet is going to move the market, if you know what I mean. And I've seen it in intraday trading repeatedly. Consequently, what I'm about to say doesn't come with a high level of confidence. So I'm going to attempt a screen share here. Let me know if you are able to see it, hopefully. This is a very, very simple daily chart of the ES, which is the mini contract of the S&P instead of seeing the SPX. The reason I chose it is because it is actively traded. It's a futures contract among the 4 principal indices. And in my own course that accompanies our software, etc., we trade the indexes as teaching vehicles, although the system works on all trending markets. With that being said, each of these bars represents a daily bar. This is your current bar, and it's updating in real time as we look at it. I'll bring the, let's see if I can bring the data box back, and I'm going to have to drag it over. Here we go. And I'll put it right about here. I have no moving averages or indicators on here, and I do that for a reason. Primarily because a lot of people depend way too much on indicators. Yes, I know price action is a biggie if you're a day trader. But what I'm seeing here from a purely support and resistance point of view is right there. You see those green dots? This indicator that does plot resistance swing high pivots or swing low support pivots. The most recent pivot is way back here on March the 21st. Until we close below that and keep going, we don't have a true downtrend. That's basic technical analysis 101. Now, I could use a moving average crossover methodology and say, yeah, we're going to change the trend. But what I would prefer to do is instead invite you to just drill into a single day for an early warning sign of what might be coming. Up here where my cursor is pointing, if you're able to follow it, is a series of pre-selected templates for different settings. These are all divisible into the number of minutes that there are in a daytime trading session. From Chicago pit time at 8:30 until 3:15 close, that's 405 minutes. Each of these settings are divisible into that so that I have cycle space charts that are relatable. So if I go to a 135, move it over, you can already see that this most recent swing low support level, we've closed below it and continued to trade below it. We did not trade back above the most recent swing high. We are trading below it currently as of today. I could drill down to lower settings, but my opinion is that we may be seeing the early warning signs of a change in trend. It won't be bona fide until we really close below this support level. So all things considered, I don't have a high confidence about the trend continuing for the rest of the week. I think there may be a change in trend to down. We'll just have to wait and see. So that's my opinion.
Okay, do you want to give up, down, and a percentage?
I think it is tending towards down at this point in time. Unless we trade above this swing high pivot, my confidence isn't restored about the uptrend. For now, I'm leaning towards down with, I would say, medium confidence. So
Okay.
I'll stop sharing.
Okay, thanks, Michael. So let's go on to Mark Sachs.
Well, I'll tell you, I think this is a really tough week to call because, as Michael pointed out, Trump's tweet this morning or last night just really has really tanked the markets. So if you were to ask me my thoughts about a longer term time frame than just 1 week, I think it'll be easier for me to call. This is a really tough week, given that bit of news on initialing a deal with China. But what I still have to call is still an up week from here to the end of the week. And I think that what I would like to do is just I don't have time to recalibrate all of the whole system for the time frame I want to look at. I'd just like to show you my chart. It's going to look a little bit complicated.
So I guess at this point, we're also explaining the reason behind our thoughts. So we'll skip the next question. So that's fine. We'll put the two in together.
Now, if you can see my chart, this is a Unorenko chart.
And I'm not seeing anything, Mark, unless anyone else is.
Can you see it?
Nope.
Okay, hang on.
Yeah, I'm not seeing anything.
I have it. I have share.
Okay, we see it now.
Okay, and we've been making a series of sequential higher lows and sequential higher highs. and we've been in this uptrend. Now we're getting this pullback right here. And we're right here at this pivot or support level. So what I see is a potential buying opportunity here. I still see the market in bull mode. If you'll notice the first line, which is what we do is we look at the correlative markets. We don't trade one market in isolation. This first line is looking at the multi-time frame trend of the NASDAQ, the Dow, and the Russell. And we're trading a chart of the E-mini. We know that at least in this short time frame, they're heading up. The second and third lines are momentum lines. The first line is a multi-time frame assessment of momentum. The bottom line is the short-term time frame assessment of momentum. This is a Ligier oscillator. They're all heading up. See that background bias is cyan, which is also up. So I see this as a potential buying opportunity. I mean, I have stocks on my radar and options positions I'm looking at that I'm thinking of taking bullish positions in, because I believe that the market is going to find footing, and from here head back up. This is a tougher. This is I've been on about 4 or 5 times. This is the toughest week to call, but I'm slightly bullish at about 60% here. And I just think this is creating some trading opportunities for some really, really superior stocks that have taken a nice bashing today.
Okay. Thank you, Mark. Let's move over to Jim Kenney.
Sure. I'm not going to have a lot of charts, so I'm going to get to the bottom line of what I see, because I have a lot of things that go into my my formulas. With regards to the put-call ratio, it jumped up to 85. That was ridiculously high. The VIX went down to 11 or 12. That's ridiculously low. So obviously when we were at the high point, we ran out, and the valuations at 18, 19 times on earnings. So the valuations were crazy. The bullishness was crazy. And whether it be Trump's tweet or something else, it's not shocking we're having a pullback. Now, if we're going to get to what's going on in my broadcast I do every Friday, when we're at 2350, I was saying we're going to go back to the 200-day average, which was 2750, which we did. We went through it like a knife through butter. Then, of course, the next target is the highs, which was around 2950, which we did. So my big view is that my range of the red zone, I call it, is 2950 to 3100. That's the area where you should be playing defense and protect your money, between 2950, which we already hit, and 3100. Now, as far as today's concerned, we came down, we tested last week's low. That's what that chart was telling you. Last week's low has been tested, and it held. So obviously, with the VIX blowing up to 18, 19 today, and now coming off, and with the big gap above the market, you'd have to bet that there could be a pop back to the upside, and then take that bet off if we break under 2900. So basically, what do I see? I see that we have a chance to fill in that gap a little bit, and maybe Trump tempers down some of these massive things, because his experience with trying to work with condo associations and then working with the Chinese may not be transferable. So some things you might do to threaten a group of condo owners might be a little different than trying to threaten the Chinese. We'll have to see how that plays out. But today, obviously, caused a lot of fervor in the world by throwing that tweet out. But if you know anything about the guy, he obviously can tweet the direct opposite by noon. So the bottom line is that what are we going to do here? I think if it holds this 2900, last week's low, we can go in there, fill those gaps as the VIX comes back down a little bit. And then, of course, if we break under 2900, all bets are off. We're going to go in the soup. That's my view.
So up or down by the end of the week?
Oh, I said up. I said up
Oh,
unless
wow.
we've taken
Okay.
the 2,900, but it's 50. It's 55 over 50. You know what I mean? It's more likely than not by a very small margin, because again, we are breaking off a very overbought condition, and we've got a president with one more tweet. We take out 2,900, you're in the soup. But again, because he has a dual personality, he could obviously moderate what he said or something else, and then you could go in and fill this gap that just was created between 2,950 and 2,925.
Okay, thank you, Jim. So I'm sharing my screen. You guys should be able to see my screen at the moment. So I'm kind of 50-50 on this, but we do have a bit like what Michael said. We have kind of broken the trend somewhat on the way I retrend on the daily chart. Yeah, we went below this pivot low over here, even though we kind of bounced back. The trend is kind of under pressure now. So we really need to, take out the highs over here to continue moving higher. And any moves up may, if we don't do that, we may kind of turn to the downside again because we took our hit. Now that's only on the daily chart, and I usually do it from the monthly chart down. But if we go up to the monthly chart, and let's go, we last month, yeah, we broke to new highs in April, yeah, and we closed above the recent high over here. So a pullback into this area, this now becomes demand. Supply becomes demand because we're now closed above it. So we've still got potential to move higher based on the monthly chart. We still haven't broken anything there. And if we go down to the weekly chart, the trend on the upside is still intact until we go below this area over here. And what Michael was saying on this is almost kind of almost matches up exactly to this area. So we could still remain bullish if we remain, even though we've kind of got some bearishness here, the fact that we've gone below and that we gapped down today, we could, we're still bullish on the weekly and the monthly charts. So it's kind of 50-50 depending on how this plays out. And pretty much if we go above the highs, obviously we're probably likely to go higher. And again, probably below this area or below the lows here. If we take out this area, then we'll probably potentially start a move to the downside. But it may, based on the bigger time frames, it may, if we do move down to the 2,800 area and we get bought again, then we could still move higher. This may just be a move down to go higher. And it's just the way you reconcile all the time frames. So we've got a bit of an issue on the daily chart, but we're still intact on bullish side on the weekly and the monthly for now. So the daily chart may get pulled back in line with the weekly and monthly and continue moving higher. But if it doesn't, obviously we may go down. So I'm like 50-50 at the moment. It is a very interesting week and probably a difficult week to know what exactly is likely to happen. So you have to trade it as it's happening. So today was a day to buy that down here, yeah, and potentially see if we can fill the gap, but with caution on the upside. Okay, so let's move over to our next question. I think we've answered the next question. Everyone's gone through and explained the reasoning behind. So let's move on to the next question in the report on page 4. The next question is, what advice would you give and or what resources would you recommend to someone who is new to trading? And we'll start with Michael.
Well, I would assume a few things first, that they at least know technical analysis. So that's important. My bias, of course, is day trading because I still have to take into account those tweets, but I don't need to have a crystal ball. I don't need to know what's going to happen 3 days, a week, a month, or year in the future, because all of my setups for my trades are intraday. So it really doesn't matter whether the market is going up or going down. If somebody is starting out and they don't want to risk, proviso is, of course, that they have the time. If you got a full-time job, that might rule it out. But if you have the time for day trading, even if it's part-time, because my system will allow part-time trading, I would recommend somebody seriously consider day trading instead of position trading or even swing trading. So that would be my recommendation.
Okay, thank you, Michael. Let's move over to Mark.
Okay, I'd like to share my screen again if I can. Let me just bring them up again. Okay, I'd just like to show these are the results of our day trading today. These are all live trades taken in my trading room. We made 400. Whoops. Oh my gosh, turn this thing blue. Let me do it over here. We made 445 bucks. I only lost $40 on one trade. We had 7 winners and 1 loser. And what we're looking for is a $2,000 week after commissions. And we only trade 2 contracts, very small numbers, so that everybody can do it. And I totally agree with Michael that the first thing that you need to understand is price action and market structure. Before you can go to any type of indicator analysis, you really have to know the basics. But I think that the market is in a little bit of a different position today than it was 10 years ago. Mm-hmm. And 10 years ago, in general, the power of every buyer was essentially equal to the power of every seller because there was little institutional participation in the market. But as we move forward, that institutional participation is now a greater percentage of total volume every month, every year. And I think it's only going to get worse. And institutional volume kind of skews a lot of things. You know, that intrinsic waveform that may have been present when Elliott created his Elliott wave theory is now destroyed by institutional money and institutional volume. The same thing with Gann theory, the same thing I think with Fibonacci, and to some extent with market structure and price action. So I think once you get the fundamental understanding of price action and market structure, which you must know, the second thing you have to also have, what I believe is essential, is have indicators that allow you to track the direction of institutional money. Now, that's very commonly said that a lot of things do that, but you can't do it directly. You can only do it indirectly. But if the software you uses tracks it with great precision, then it really fine-tunes your entries. And that's why today I was able to get 7 winners and 1 loser, and the 1 loser I took was only 40 bucks. Because I always trade respecting price action and market structure, but in the same direction as money flow as calculated by our software.
Okay, thank you. Let's move over to Jim.
Well, I think the basic premise that I try to explain to people is something I learned from Marty Zweig decades ago, and that's don't fight the tape and don't fight the Fed. Now, I like to rely a lot on things that we know for sure, which is obviously something that's already occurred. So I like to look at things like the daily, weekly, and monthly high lows. That sets the parameters of exactly what the market's doing. If you're day trading or something like that, you're going to use shorter term horizon prices, right? Because you're going to be trying to keep it on a very short leash on a day trade. And as you have a longer term perspective, you use the longer term numbers. But the high, low, and last for the daily, weekly, monthly is obviously a good way to track the prices. Then I like to use the moving averages because they're based on price and time and they're not debatable, right? So basically you have different moving averages for different perspectives. Then I try to look for overbought, oversold. A good example recently was Amazon last year, I guess, went to 2050. The moving average was at 1500. That's 40% of whatever it is, 30% above its 200-day average. That's very excessive, and the likelihood of coming back down is quite high. We saw it recently with Boeing at 446 with the moving average at 355. You can't predict the plane crash, but you know something probably will occur to bring it back in. And so basically, I like to use the moving averages to indicate what the flow of traffic is, plus overbought or oversold. These are things that individuals can do, but it takes a little time to follow them. But they'll be following the price, and they'll be following the flow of the price. And I think that's a valuable thing to do if you're trying to do it on your own and you're trying to keep it understandable and not get paralyzed by your analysis. So I like to look at those type of things to give me an idea of what's going on. Of course, I look at many, many things because I've been doing this for decades. But if I was going to say to somebody starting out, let the numbers dictate what you think is going on, because the numbers are what you're investing in. So focusing on what the prices have done, what the moving average of price has done, I think it's not a bad thing to keep an eye on.
Okay, thank you, Jim. So my advice for a newbie trader starting out would be, again, learn how to read the markets first from a professional perspective. And I would start without any indicators at all. I mean, in the beginning, when I first started trading, I used many indicators, and then I don't use any indicators now. I use actually one, the CCI, for certain types of trading, mostly for base trading and for kind of gauging when a breakout's going to fail, like bull traps and bear traps. So I've found a certain pattern that repeats itself again and again, and I've been kind of following this pattern for probably over 10 years now. And so what I would do is start with the basics, understand how to read the trend using candlesticks alone, understand Japanese candlesticks, but more importantly, understand how they form trends, when trends begin and when trends end. Understand supply and demand, how to know where those zones are. They're not price points, they're areas in the market where institutions are primarily buying and selling, big money's buying and selling. So understand where areas of supply and demand are, because that's primarily where the market's going to move from and to. And understand what direction price is currently moving in. And if you can do all that on multiple time frames, that's your framework for understanding any market. Once you have that framework, you can apply it to any market. Once you can chart it with Japanese candlesticks, then you can understand where price is location-wise. You can understand what trend you're in, and you can understand whether you should be on the buy side or the sell side, and when to get in, and where to get in, and where to get out, and when to get out. So you need to know that in order to trade. And then once you've got that framework, you can then build your own strategies and not have to rely on anyone else's strategy. You can build your own. And some of my best traders have built their own strategies once they've understood the framework and gone on to be very successful traders. The other advice that I would give is much like what I said earlier. Once you know how to read the market, watch the market and derive for yourself a strategy. Have a look and see what repeats itself again and again, and see if you can write those rules down of what it is that you're seeing, and then how you're going to get into the trade, how you're going to get out of the trade. But it starts with observing the market. Once you have that, you need to be able to have a framework in which to develop yourself in a safe way as a trader. You need to know what you're doing on a day-by-day basis, hour-by-hour basis, or when you're trading, what you're trading. You need to have a trading plan. You need to log your trades, and you should journal yourself as a trader. And you need to keep track of every decision you make in the market, why you're doing it, what you're thinking, and what your emotions are telling you to do. With all that information, you can improve yourself on a day-by-day, trade-by-trade, week-by-week, month-by-month, continual basis. And you'll be able to know what's working for you and what's not. If you have a losing trade, go over it, study it, figure out why didn't it work? Did I do anything wrong? What can I learn from it? If you take every trade, especially the losing trades like that, and learn from every trade, you're going to improve your trading. Don't be upset by taking a losing trade. Use it to learn from it, and then it's not a losing trade anymore. It's a trade where you're going to learn how to improve yourself. Take that perspective when you start out trading. Don't try to make money at the beginning. It's not going to happen. Most likely not. Or you'll get lucky. I mean, I remember when I was starting on the trading floor, there were some lucky people that actually made money at the beginning. They didn't last very long because then they blew up at some later stage. Go steady. It's not a sprint, it's a marathon. Take it easy and learn. if I would have my time again and knew that at the beginning, instead of trying to make money at the beginning, I would focus my attention on learning how to trade. I believe that that's the number one reason why people fail as traders, because they don't know what they're doing. Learn how to trade first and then make money. Once you know what you're doing, it's much easier to actually do it. If you try and make money, you don't know how to trade, it's not going to happen. So that's the advice I would give to any newbie trader.
Simon,
Okay.
could I add a postscript to what I was saying?
Sure.
Okay, I do concur with a lot of what the other gentleman said, particularly with your remarks also. I have probably coached over 3,000 students over the years. And one of the things that I have learned, and I'm in complete agreement, is you really must treat it like a business. And in order to do that, you must track your stats. You must journal each trade. You must build up an actual track record. You must benchmark what you're doing with a statistically viable sample in order to know how to proceed. Otherwise, you're just shooting in the dark. You don't have a clue. One final remark. I did hear someone refer to institutional presence. I haven't traded a share of stock since 2001. The reason why? I started out in the earliest days of SOS trading in the early 90s, and it was this whole thing about how to route your orders as a day trader. And that's a big, complicated area. Do you use Archipelago, Black Pools, et cetera, et cetera? I just would rather avoid the whole institutional issue and not trade the stock market. I know a lot of people say, oh, that leaves out so many people. Actually not, because it costs $25,000 in your account just to start day trading. But if you only have, say, $4,000 or $5,000, you could start day trading futures and commodities, the indices, for example, or maybe natural gas or the euro, the 6E. But you would completely avoid that high frequency algorithmic trading issue that exists in the stock market. In the indices, it is present, but only in the ES. So I don't trade the ES anymore. I just trade the remaining three indices. So that's it.
Okay, thank you, Michael. Let's move on to the next question, and I'd like to ask all of you to maybe share.
Could I add a quick postscript?
Yeah, sure.
Thanks. I just wanted to just say this, and this is my own personal opinion, obviously, and I really concur with 99% of everything that my colleagues have said. The only thing that I feel a little bit different about now, let me say that understanding areas of support and resistance are critical. That analysis is fundamental to understanding how to trade, and it doesn't make any difference whether you day trade, swing trade, and it doesn't really. I don't think it makes any difference. What financial instruments you use, options, whatever. You have to understand areas of support and resistance and how you define them. The thing that I disagree with a little bit is this: I don't believe it's possible anymore to call a top or a bottom, because unfortunately, institutional money is going to press a stock, a future, or a Forex market long, for instance, as long as it chooses to. And we all know that there's stocks and there are markets that can move to overbought and stay overbought for significant periods of time. Divergent signals no longer work because you cannot counter trend trade against the direction of money flow. Once the institutional traders step aside, so I think if you try to call a top or a bottom using an oscillator, which is a mathematical assessment of momentum, it's not going to work as long as money flow is pushing this price further and further away from the mean. I think you can only trade, as everyone has agreed, in the direction of the trend. The only thing that's going to bring price back down is another mathematical principle, and that is regression to the mean. When institutional money steps aside, price is going to snap back to mean. Now that mean can be the 50 period moving average for you, the 100 period, the 100, the 200, however you define mean price. The further away from the mean price has been driven, 1 standard deviation, 2 standard deviations, even 3 standard deviations, and kept out there for a significant period of time by institutional money that just continues to drive price higher and higher, the faster it'll snap back to the mean once institutional money steps aside. The problem is we never know when they're going to do that. So I think it's just important to understand that any financial instrument in any market at any time can stay overbought for days to weeks and months. And all we can do is trade in the direction of money flow. And if we try to counter trend trade against that parameter, we're usually going to get run over. And, you know, that's just something I think is important for my trading and the way I look at the markets.
I mean, so one thing I would add to that is sometimes you can be in an overbought situation and the market's gone up, and instead of snapping back, it consolidates sideways and then has another leg to the upside. So there's two ways the markets can actually consolidate. They can move down when institutions step aside and there's enough supply and not much demand because they pull the demand out. Then the market can move to the downside, which is consolidation in price. But markets can also consolidate in time, which is much stronger. They can move sideways. So they don't go down in price. There's enough demand to keep the price at those levels that it's not dropping. And when the institutions step back in again, they go up to new highs.
You know, I agree with you 1,000%. In fact, you know, the market is trending and then goes into consolidation. It most likely will break out of consolidation back into the same trend it was in when it went into consolidation. So if it goes up and then consolidates, the longer it consolidates, the better. Because what happens during consolidation? You're trapping buyers and sellers in a very, very narrow price range, and they're all sitting there scared, because if price breaks to the upside, it's going to stop out a huge number of sellers and rocket price out of consolidation. If price breaks to the downside, it's going to stop out all the buyers and it's going to rocket to the downside. So the longer a financial instrument is in consolidation, the better. And if you're going to look for a direction to take consolidation, the best direction to trade consolidation is right back into the direction it was in when it went into consolidation. And remember, you're leveraging all the sellers in the counter trend direction in that consolidation channel. And they're going to help propel that trade for you in the direction that you want it to go, right back into the trend.
Yeah. Okay, so let's move on to the next question. And what I'd like you guys to do is to share a trade idea with the audience. So whatever you're looking at, could be anything, commodities, stocks, Forex, Bitcoin, cryptocurrencies, whatever you want. And just share maybe what you're looking at this week or in the near future, and any trade ideas. So let's start with you, Michael.
Gee, a specific idea. I do the same thing over and over again. I'm a one-trick pony. I have a system.
I do the same, Michael.
Yeah. Basically, what I do is every time I sit down to trade, I'm going to start with a chart. I start with a daily chart, and I use those smaller and smaller time frames, not the ones that are the generic drop-down menu. Depending on the market that I choose, I have to determine the cycles within that market. I'm not talking about Elliott wave and any of that stuff. You know, that's history now, as others have said. Okay, I'm guessing we're supposed to see a shot of a youngster there. I don't know. Was that intentional?
That's my son. That's my son in a when he's playing paintball. That's just my screen share. I'm sorry. I can turn that off.
Yeah.
Hold on.
I was getting distracted there. Okay. And I'm sorry, I don't have a particular chart right now. Next time I visit, I will walk you through what is an actual top-down procedure that we go through. Essentially, the indices, as an example, and you can make plenty of money with the indices because they're inherently trendy. Maybe not as much as currencies, but I've noticed that, you know, if you use the 8:30 to 3:15 daytime trading session, that's the pit trade time, and you look for the smaller and smaller setting charts that divide into that 405, you get 135, 81, 27, 9, 3, and 1. Oh, that's as far down as you go. And essentially, in my course, we use the 9-minute chart as our wide angle view. We use the 3-minute as the dominant cycle, and we look for the low risk surgical entry on a 1-minute chart. And of course, we supplement that with tick charts. But we look for trend agreement in order to determine what type of way we want to manage and exit the trade well before we enter the trade. The more trend agreement you have, the more you want to swing for the fences. Therefore, a scaling out exit strategy with a trailing stop, automated, works great. If you've got a little bit of trend agreement, say only the 1 and the 3 agree, then perhaps you would scalp, just all in, all out. You hit a quick and easy ATR target, 1 average true range. You got a 90+% likelihood of having a winner. And that way, you aren't using a one-size-fits-all exit strategy. So my suggestion is that if people this week or any other week want to try to day trade, they first want to pick the type of market where the institutions aren't hanging out, that you don't have all those complications some of the other gentlemen spoke about. And number 2, make sure that you know, as we've all been saying, and wiser people than us have said, trade in the direction of the trend. Which trend? At least the 1 and the 3, preferably all 3, 1, 3, and 9. Once you get above a 9-minute trend on an intraday, the higher base time frames have 0 influence on a 1-minute chart. It's way too many levels removed. So I could go on. Next time I visit, I will. Next.
Okay, thanks, Michael. Let's go on to you, Mark.
Okay, I just wanted to give a little bit of advice to anybody who's thinking of trading, and that is, if I always ask my traders who I mentor in the trading room, what's your number 1 goal? And almost everybody says it's to get a winning trade, and I'm telling you that's the wrong answer. The wrong answer is to avoid a losing trade. If your goal is to get a winner, you're trading with sensitivity. If your goal is to avoid a loser, you're trading with specificity. Every trader gets plenty of winners. The ones that bust out of the market, and this is the majority of traders, pull in too many losers. So you have to trade with tremendous specificity. It doesn't matter what it is or what trading methodology you use, but you have to have patience and discipline to wait for everything to align to take a low risk, potential high reward trade. And then trade management is so key. That's the thing that I screw up on the most. I get a lot of winners and avoid a lot of losers, but then you got to monetize the trade. You got to milk the trade. And that's really hard. That takes a lot of work. And that's really what all the experts here today are going to help you do. When you get a winning entry, run with that trade. And it's not easy. And I do have a couple of quick suggestions. I really like, my number one is I like this big pullback on Avago. I mean, it's one of my favorite stocks to trade. It's very expensive. I wouldn't buy the stock. I would buy a vertical call spread, and I would buy the 310, 330 vertical call spread. Right now, Avago's at 310.57, and I really like that. I like the June 21 330 310 vertical. The other one I really like is I like. Hang on one second. Let me just, I have my list right here. Just have to split it off and drag it over here. I really like, where is my list here? Electronic Arts. And I would recommend a calendar spread on Electronic Arts. I think it is chugging a bit. I think it is overbought. Earnings are coming up. It historically disappoints, and I think a calendar spread on that is a real good trade. And I have one other, and that is and actually what I'm doing is I'm taking this off the ticker. This is a trade from Benzinga, but I really like it. It is a spread on the USO, and I think that oil is going to head up, and there's a lot of money going into the July $13.50 call. Right now, it's only trading for 42 cents. It's a very, very inexpensive call. It breaks even at $13.92. You only need 42 cents to break even. And, I think you got a shot at a nice runner here. So those are my three recommendations.
Okay, thank you, Mark. Let's move quickly on to Jim, and we've got one more question after this.
Sure. Again, as we went into that rally on my broadcast, I was telling people to investigate selling calls into these rallies because the earnings and revenues recession seems to be on. Yes, we're beating estimates a lot, but if you go year over year, which is I'm looking at, we're definitely not beating anything. So this big rally we saw into 29.60 and with the VIX at 85, the VIX low and the put call at 85, I thought investigating selling calls and investigating collars where you sell calls and buy puts made a lot of sense. So far, that's been very good. Now, there's two things that I would say that could be interesting because they fit a little bit of the parameter I look at for some type of trading. There's a lot of different trades out there, but this is a couple things. One is the overbought thing. Now, I'm monitoring Chipotle Chipotle restaurants because it hit a high of 721. And the 200-day moving average is at 528. That's 36% above the 200-day. If we go up to 800, we're going to be 52% above the 200-day. And this is a company that's valuated out at what? At about 100 PE ratio or so. So my point is that's something I would investigate and keep an eye on. If it takes out 721, obviously there's no bet. But if it starts closing under 675, that would be the lowest close we've seen in 3 months or so. That would start getting interesting that it might be rolling over. So Chipotle is very overbought up here, but there's no exact science. It could be going to 900. I don't know that. But if you do a limited risk put, at least you know exactly how much you're risking. And obviously, if it works and it goes back into the fives, it should work out pretty good for you. But again, you got to wait. We were talking about discipline and patience. You got to wait to see a little bit of a crack in the armor, and we haven't really seen it yet. Second thing is the president has been talking about helping the farmer. The farmer's going to make out like a bandit. I'm going to make this deal so great for the farmer. Well, they're not doing so good today. Soybeans just hit a 52-week low. and some of the other grains have got hit too. But if he's going to follow through on this thing, and at least temporarily he seems to follow through on many things, then there could be value in the agricultural sector down here if there's any deal to be made. So agriculture way down and out of favor with a possible deal that would help them could be interesting. And if Chipotle can't take out 721 and takes out 675, that could be interesting. And those would be two things to put on the radar.
Okay, thank you, Jim. So everyone over to me, you can see my screen. Last time I was on the Timing Research Show, I believe, or maybe the previous time before that, we talked about Bitcoin. This is Bitcoin futures being a potential on the long side if it breaks above this area. And you can see it's kind of, it did it on this week, broke up above this area and moved right up. So that was a trade that we talked about way back when. You can go and look at the archives and understand the reasoning behind that trade. And I'm going to show you two others, potential ones. This is gold that's not set up yet, but I'm expecting this to not go to the bottom here on the monthly. This is a monthly base, and we've been basing for quite some time. I'm expecting this to turn and break above. If it does turn here, the odds are it's probably going to break above here, and I'm looking for this to move up to around the 1600 area. And again, I've got my, it's not ready yet. I'm waiting for it. There are ways that you can trade by getting in on an idea and actually making money, even if the idea does not play out. And that's a great way of trading, actually. For example, you could buy down here and get this move, and even if it does turn down, you can make money on this move up, and likewise this one. And we kind of gapped up it right into the supply area, and these lines were drawn beforehand. These are my supply demand zones that I'm watching. And the final one is oil. We look at oil. And we talked about this a couple of weeks ago over here, that oil's likely moving down to the 60 area. And look at that. And here is exactly the same sort of example as what we see on the E-minis on the S&P 500. We can see the trend here changing by this move down and this move up, therefore, putting in a lower high and a lower low. But the trend here is still intact. And we're still moving direction-wise to the upside. So what happens is, the trend here will probably change. This downward move will change in areas where this trend will potentially continue moving to the upside. So this was one of those such areas where this trend may come to an end and we may continue moving higher. So this is oil. And again, one of you said also oil may be an interesting buy. Again, today down here was a good buy if you bought during the Asian session, or even anywhere. If you found some entry anywhere today on the long side, you were on the right side. Okay, let's move over to the last question, and we'll go through this very quickly. And what I'd like you guys to do is just to go through any closing thoughts or final statements, anything that's going on with your site or anything you want to share, how people can be in touch with you. And we'll start with you, Michael.
Well, thank you. Again, I'm the newbie, so I'm not real sure how the format works, but I do invite people to visit daytradesafe.com. That's all one word, daytradesafe. Get in touch with me using the little messaging thing that's on the site, and I'd be happy to visit with you. I allow up to a full hour so people can get to know me personally. I don't want people actually investing in TradeSafe until they've had a chance to get to know me. I know that sounds counterintuitive, but a lot of people, they're used to being abused, shall we say, in this industry. I've been in here a quarter of a century, and I know what it's like. So I want you to know nobody's going to twist your arm. All I will do is answer your questions truthfully and honestly so that you'll feel you come away with what you need to make up your own mind. That being said, a quick recap of what you will be able to get in TradeSafe and what I think this can do to help you be a better trader with this kind of crazy market is, if you aren't sure if you have the time because of a job, talk to me. I have worked with people around that. Otherwise, I would say, as I agree with Simon and others, and I'll keep it short, benchmark yourself, record all your trades, have a methodology, use a trading plan, be consistent, use routines, treat it as a business. I could go down the litany, but I think it's been said already here before. So I don't want to take up any more time. Next.
Okay, let's go over to you, Mark.
Listen, I just wanted to, I think it's Jim. I totally agree with looking for a crack in Chipotle. I think it's way overbought. And I think if it does start to crack, it's a great short trade. And I also totally agree with him on the agricultures. They have been beaten to death. They are at the, I think they're at the bottom. And I think they ultimately will have real nice upside potential. I'm at www.rightline trading, all one word, RIGHTLINETRADING.com. I day trade the NASDAQ and crude oil every morning from 9:30 until this morning. We were done at around 11. I don't want you to buy anything from me. Allow me to mentor you. Come into my trading room. Watch me trade. There's 150 traders in the room. If I can't do it in front of you live, then you should find another place. But we do it almost every single morning. So if you just contact us there, or give us a call, just go to the website. We'll give you a free trial in the room, and you can see exactly how we trade.
Hey, thank you, Mark. Jim, let's go to you.
Yeah, the website is optionprofessor.com, and that's where you're going to get the link so you can listen to my broadcast every week. And I've been doing this for decades and decades, and I obviously know a lot about investing, but I'm the first one to tell you there is no definite and there is no surety. This is all about probability and taking chances that hopefully make sense. But what I am going to say is I do go over strategies that are defensive. Options, obviously, are risky by nature. You can use them for limited risk speculation, but you can use them for cash flow purposes, and you can use them for defensive purposes, like replacement trades and collars, etc. So what I bring to the table is knowledge, experience, and a little bit of my observation and my view on the stock market, bond market, oil and gold, and the US dollar, which pretty much is across the gauntlet. So the other thing I do is I want you to go to the website and get the link, but I also want you to use the email, optionprofessor@gmail.com. Something you're confused about, something you'd like another opinion on, no problem. Shoot me an email, and I'll try to give you a hand. Thanks a lot for moderating here, Simon. You did a great job, and I was very happy to be here today.
Okay, thanks, Jim. And finally, you can go to my website, tradesmartforex.com. You can see it here. I'm showing my screen. If you want to get to know me first, which I advise you to do, is you can put your details in here, and you can watch a quick 15-minute video, which will tell you how to go about building a profitable trading strategy. So that's a good place to start. And you'll be on my mailing list, and you'll be informed about webinars I do like this one. And I've got one tomorrow around the same time, 1 p.m. Eastern time tomorrow. And you can go to the link here. You can actually get it from my website. It's over here. It says register now on the main page. It's the easiest way than remembering the URL. And click here, register, and come and learn about one simple adjustment to making 7 times more profit. These are things that you really need to know. Small adjustments that you can make in your trading that make all the difference. And I'm going to show you some real life trading results and the changes that you can make and what it will do to your bottom line. And also how to go about finding your biggest trading demon and dealing with that. And the 3 steps that you need to learn in order to become a successful trader. Again, you need to, if you don't do these 3 steps, you're not going to make it as a trader. So worth coming and getting this information and then applying it to your trading. Okay, thank you very much, everyone. Thanks, Michael, Mark, Jim. And I'm going to pass you back over to you, David. Thanks a lot.
All right, thanks, guys. Great show. Lots of good information today. So just a quick reminder to everyone watching, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory. And you can also go to TimingResearch.com to get access to any of the past reports or shows. Also, be sure to join us tomorrow for episode number 76 of Analyze Your Trade at the new 4 p.m. Eastern time. We're going to have another first-time guest. Marina Villatoro will be on for the first time. Also, Christian Fromhertz and Michael Filagera. And just want to thank my guests again for today. Michael Guess of Day Trade Safe, thank you for being here for the first time. And Mark Sachs of RightLineTrading.com. Simon Klein of TradeSmartForex.com, and Jim Kenney of OptionProfessor.com. Thanks, everyone.
Thanks, David.
Thank you all.
Thank you.
Thanks.